Okay, in today's video, guys, we're going to talk about the top 10 common investing mistakes to avoid. So, mistakes that I've seen over and over again since I launched my site back in 2006, and since I started kind of investing off and on for the past 15 plus years. So before I get into these top 10 mistakes, I want to just kind of talk about being a successful investor. It's more so about controlling your emotions than simply being the smartest guy or a genius or a wizard or something like that. So before you guys start investing, make sure to get control of your emotions, and those two main emotions are greed and fear. So greed and fear, those are kind of the two biggest emotions that will affect your investing in the short term and in the long run. So let's get right into it. So one is not getting started. So once again, this goes back to the emotion on fear and simply not getting started because you're not exactly sure what's going to happen. But that's a huge mistake, because the most important thing when it comes to investing is to benefit from compound interest. So compound interest is simply that as your money grows over time, you continue to earn more interest and more dividends and more earnings on top of that money, and then that grows and grows and grows. So it's kind of akin to the little test where people say, do you want $2 million up front, or do you want to receive a penny every day and double the amount for 30 days? And at the end of 30 days, that penny will, if you keep doubling that penny, so 1 cent, 2 cents, 4 cents, if you do that for 30 days, that'll end up $5 million. So you'll greatly outperform someone that just invests one time if you let the money compound over time and you keep adding to it. So once again, it takes time for businesses to grow, so this is why you need to get started as soon as possible. The best time to invest was 10 to 20 years ago. The second best time is now. So if you haven't started investing, drop everything right now. Get started. It can be as simple as setting up a simple account with Robinhood. It can be as simple as setting up a retirement account through Fidelity. It can be as simple as starting partial shares with Dash Invest. Get started now. Even if you only have $5, just get started, because you want to build the habit of this. So this isn't something where you need, a $10,000, $100,000, $1 million to get started. Start with what you can now and build up over time. So number two, the second one is investing in a business you don't understand. So this one is a really important one, and it kind of is common sense if you think about it, right? You want to invest money in a company that you understand. So, for instance, if you invest money in Apple stock, you're pretty much easy to understand how the business makes money. They sell computers, they sell phones, and they sell services. So that's the type of business that you want to understand, and that's the type of business that you want to invest in, something that's very easy to understand. So for me personally, I know a lot about tech companies, so I like to invest in companies like Apple, companies like Roku, companies like Netflix. These are tech companies. I easily understand how the businesses work. So for me, example, I'm not good with oil companies, so I wouldn't invest in the oil stocks, because I really don't understand how these companies make money, how oil prices ebb and flow over time. It's just very confusing for me, so I stay away from oil investments. And since a lot of the future technology is going to be solar and going to be electric cars and things like that, I think people are going to be less dependent on oil. So why did you do this? Because you won't be able to tell if things are going well or not without understanding. So buy a few books on Amazon to learn more about any industry before you invest. Make sure you understand the business. So number three is taking investment advice from family members. This is actually a mistake I made recently. I invested in a company called Naked Brands via tip from a family member, and I lost over 75% of my investment. I had to end up dumping the stock. So why did this not work? Well, it simply didn't work because I was taking advice from a family member. I wasn't really taking advice from someone that was experienced in the retail industry. So Naked Brands is a retail company based out of Australia, and the person I got the advice from, a dear family member of mine, they're not an expert in retail. So if you're going to take advice from someone, make sure you take advice from someone that has experience and expertise in that specific industry. I love family members. I would never tell you not to listen to a family member's investment advice, but just realize they aren't the best people to take investment advice from. Listen to their opinions, but always do your own research first. So number four, investing money you can't afford to lose. So investing only works if you let the money compound at a time. It doesn't make sense if you invest and then you're up a bunch and then you take the money out and you buy like a car or a house or something like that. That kind of is just going to ruin your results. So make sure that you're investing money that you can afford to lose, because at one point you will lose. No one is going to have a 100% rate on any investments. And if you're listening to someone who doesn't show their trades or their accounts, then be careful, because you could be dealing with a dishonest investment advisor. So the easiest way to build up money that you can afford to lose is simply pay yourself first. A good way to do this is you can simply take 10% of the money you get up front and send it to your investment account before you pay your bills, and learn to live off the remaining 90%. What this will do is you won't even realize you missed the 10% in the beginning, and that money will continue to build up over time, and you learn to live off of the other 90%, paying your bills, stuff like that. And if you guys don't have a lot of money, check out the article on my site. I'll post it in the description on how to invest $100. Number 5, timing the markets. So right now, if you guys watch this video it's January 2020, I'm posting this. The stock markets, the NASDAQ, New York Stock Exchange, U.S. markets are at an all-time high. So should you invest now or later? Look, if you use that kind of strategy of don't invest when the markets are up, then you missed out on one of the greatest bull runs in the history of the U.S. stock markets. So my advice is, do not time the markets. Just invest in solid companies, whether go up or go down. Now, I'm not telling you to buy stocks when their PE ratios are through the roof and when they're way overvaluable. What I am telling you to do is get started. So what you can do is you can use a strategy called dollar cost averaging. That's where you buy, maybe, let's say you invest $100 in, for instance, let's say you invest $100 in Ford stock every month, regardless of the price. So when the stock price is up, you're going to buy fewer shares. When the stock price is down, you're going to accumulate more shares. And that's a really nice way to build up your portfolio over time. So one of the most important things I like to do is I like to just invest regularly on a weekly and monthly basis, and I just stick to my schedule regardless of where the markets are going, because I want to get as many shares as possible. I want to build up my portfolio. And you can't build up your portfolio if you're trying to time everything, because no one has a crystal ball. We don't know where the market is going in the future. Number 6, investing with scared money. So this is a big mistake that people do. They invest with money that they're scared of losing. So if you are scared of investing, it's best to just stick to low-cost index funds. You guys can check out Fidelity Zero Index funds. They don't charge any fees, no expense ratios. You can get those by signing up with a Fidelity brokerage account. That's probably the best thing to do if you're going to be investing with scared money. And why is it this? Well, it goes back to one of the emotions I was talking about earlier, fear. So, emotional investing with scared money leads to poor emotional decision making and can destroy your investment portfolio. So how to avoid investing with scared money? Think long term, think 5 to 10 years in advance, and trust your research. There's a reason you bought these stocks, and just trust your research, that your research will benefit you in the long run. Number 7, thinking short term. So Warren Buffett once said the stock market is a voting machine over the short term, it's a weighing machine over the long term. So we can't predict stock prices. Things like earnings, news reports, job numbers affect stock prices. But over the long term, if a company is continuing to produce profits and they continue to do the right thing. Okay, so what you want to do is you want to think long term, because as you've seen with a lot of these companies like Apple and Amazon, even though in the short run they weren't doing so well, they performed very, very well in the long term, and those stock prices followed those returns. So number 8, catching a fallen knife. So this is a metaphor we use in the investment world to describe a stock that keeps going down. I think we recently experienced this with some of the cannabis stocks in 2019. People continued to buy as companies like Tilray, Aurora Cannabis, Canopy Growth continued to fall, and then they ended up buying the shares at a much higher average price than the current stock market value. And one way to do that is, in real life, you would never catch a falling knife because you get cut. So the same thing is true for stocks. If the stock or investment continues to fall in price, then be patient and try to figure out why the drop is occurring. Don't simply just buy and say, oh, well, I'm going to average down. What you can do is you can simply realize that a lot of these stocks are trading based on their sector. So some of the sectors, so for instance, going back to cannabis stocks in 2019, the entire sector was down. So it didn't really make much sense to buy them. It made much sense to wait until the prices stabilize and you think the investment is trading at far below its true market value. And we've kind of seen this so far in 2020 with cannabis stocks. It seems like there's been a bottom that's been formed as we're getting closer to legalization throughout the United States, and the House of Representatives starting to pass bills and things like that. So wait for the bottom to come and then you can buy shares. Okay, number 9, not being consistent. So this is harping back onto how it takes time to build an investment portfolio. So the most successful investors, they rarely just invest one time and do nothing. So there are instances of people that invested maybe 50 years ago. They put you know, they bought 100 shares of Berkshire Hathaway, or they put $1,000 into Coca-Cola stock and it turned into millions in the future. And while these stories like this do happen, it's the exception, not the norm. So the best results is to set up an investment schedule and stay consistent. So one of the things I like to do is I like to do automated deposits to transfer money from my checking account into my investment accounts on a weekly basis. That's keeping me consistent, and it's not letting me miss time, because time is the most important thing. So whether you want to do it weekly or maybe monthly, if you want to take a portion of your paycheck every month and invest it into your accounts, that's a way to continue to grow your money over time. So even if you're just investing $10, $5, $100, in the short run, $10, $100, it won't really affect you. But over the long run, your future self will thank you, and you'll constantly see growth in your accounts. And number 10 is simply giving up too soon. So it takes years for this to work, guys. This is not a sprint. Investing is a marathon. For instance, it takes 18 years for a child to become an adult. So as you've seen over the last 10 years, we've seen a lot of companies like Netflix had 4,000% plus gains. So you couldn't have made 4,000% in just 6 months, 1 year, 2 years. It took 10 years to make 4,000% gains. So if you're looking for very, very quick gains, then trade options. But if you're looking for more long-term, consistent investment returns, kind of passive returns where you're not actively trading the market and stuff like that, then it makes sense to be patient. Don't give up. Keep investing. Great companies need time to grow their revenues and their profits. And so, you know, add it to your lifestyle. That's one of the things that I've had to do to stay consistent and not give up, because it is so easy to get, you know, emotional and get angry when your stock's going up and down and stuff like that. So what I did is, you know, I started to read books, quarterly, annual reports, watch YouTube videos. If you guys are watching this channel, that's a way to stay involved and just continuously improve your financial education. Remember, you're not just doing this for yourself. Your hard work will guarantee a better future for your future self and for your family. So this is something where the better you get at this, everyone around you can benefit from your improved financial education. So that's it, guys. My top 10 common investing mistakes to avoid. Let me know what you think in the comments. Which ones did you like? Which ones didn't you like? What mistakes would you add to the list? If you guys made any personal mistakes yourself, be sure to add them in the comments. I really enjoy you guys watching my videos, and I thank you so much. So if you enjoyed this video, please smash the subscribe button and give me a thumbs up. And until next time, take care.